Welcome back, everybody, to the program. I'm your host today, Jeff, here at Economic Preppers. And today I want to give you a little bit about real estate and how real estate is doing. Now, you probably, if you're in the real estate market right now, you probably know it's not going so well. Even though realtors and mortgage brokers and title companies, those are the deep into this business and it is their core business, are saying, it's not so bad. Everything is great. Well, just wait until after Labor Day, and I'll talk about that in a moment. But before I do, please take note of the things that are crawling across the bottom here. We have our courses available, Becoming Your Own Bank, and you get 50% off for now. If you want to grab the course now and check it out, you get links and all that descriptions, and the link is in the description below. I'll slow down and get this all right. And of course, if you like this kind of content and what we're sharing here on this video and other videos that myself and Dylan or Patrick are making, please like, share, subscribe, send out this video to other people to get them more informed. And also, as the last thing that's scrolling across here is the Silver Symposium. It's at the end of September. It's, again, Labor Day is just next week. So we're going to, the calendar is about to click over to September. And before you know it, it'll be the end of the month. And that's when we're going to be in Las Vegas. And there's going to be a ton of things that are going to be available. Membership to Economic Preppers. We're already working on the offer list of what we're going to offer members. It's going to be a long list of things that we can do. And also we're going to have lots of things at our booth. So please come out, get your free ounce of silver. So you get one of these when you come, and if you use the description has the link for discounted tickets. It's only $89 and you're getting like $30 worth of silver roughly. So the tickets are really basically only $60. It's pretty cheap to get into the conference for 2 days. Come on out and check us out. Honestly, it'd be more expensive for a meal in Vegas than it is to go to the conference. So, okay, real estate. Let me share my screen. I'm going to talk about two different stories here, and I'll give you my perspective first off. Okay, so they're both at a zero hedge, and let's try and blow them up a little bit, get a little bit more easier to read. This is about the Airbnb bubble popping. Okay, and this has been talked a lot about, and recently, housing globally is in a bubble. Okay, and I'm going to zoom. Let me read this, then I'll zoom back out so you can see the chart better. We're constantly assured that it's not a bubble, as this author discussed yesterday. The bubble is fundamentally an artifact of the central bank and government policies that are enriching the already rich, and I'll have a second story to talk about that in a moment. So they were incentivized to outbid each other with low-cost credit to snap up investment properties with their surplus capital that generate more income and capital gains that cash, which until recently was trash due to near zero savings yields. All right, what's all that? I'm going to break that down in a minute. So first, let's take a look at the chart. And sorry for the scroll there. There you go. So this is basically comparing 06 to 22, and you can see that they forget all the metrics and Case-Shiller index. That doesn't matter. All that matters is the shape of the graph. It says that the blue line went up in the period of 180 months. That's 15 years. It went up to 109 from 0, and then it's already at 174 in 10 years instead of 15. So basically, right now from the 2012 to 2022, it's gone up way faster. All right. So it's getting much harder to buy real estate. A systematic driver of this, let's scroll down here, trying to give you a nice view, be able to read along with me. A systematic driver of this bidding war for rental properties is the Airbnb model of monetizing individual properties to compete with hotels and resorts for lodging. This is abbreviated, yet another acronym, by STVR, or short-term vacation rentals. Now, this is a good graph of, I'll have to zoom out one click. There we go. So this shows the total housing units compared to total population. So the population's in blue, the housing units are in orange, and you can see that the housing units per capita, it's led to an artificial scarcity of housing in popular tourist destinations. They talk all about this. I'm going to jump to the important stuff that I highlighted here. The Pareto distribution, which is basically your 80-20 rule. And I'm going to zoom in on that, try to make it a nice screen. There we go. The Pareto distribution is often summarized as the 80-20 rule. Now, they go on further to say the 80-20 rule can be distilled down to 80% of 80% and 20% of 20%, where 80% of 80% is 64 and 20% of 20% is 4. So that's they're defining that as the 64-4 rule. The vital few, 4%, exert outsized influence over the 64% mass. What that means is that 4% controls like the most recent value. So the example here in yellow. So 40 houses selling for around $450,000 will reset the valuation of 1,000 nearby homes from 800,000 to 450,000. That's a lot of equity that those other homes would lose. For rounding, I'll just call it 1,000 homes. So 1,000 times 350, that's $350 million of equity lost, give or take, those 40 houses. That's a lot of money, all but based on 40 houses. So the STVR bubble, or short-term vacation rental bubble, was entirely an artifact of historically absurdly low mortgage rates. And number two, post-pandemic price-insensitive revenge spending. Both are over. So here's one more graph that just shows the erosion of the median rent price going up compared to the household income. So rents are increasing, mortgages are increasing. So basically everybody's tapped out. And how you see the last graph is that investor purchases have rapidly declined in the last 2 years because people don't have a disposable income. Now, I'm going to break that down in a minute. Let me give you this example of what I said earlier in this article, which is that the wealthy are concentrating and buying up a whole bunch of stuff. Here's another story that came out of Zero Hedge. A group of Silicon Valley billionaires are behind $800 million in land purchases, or about twice the size of San Francisco, near Travis Air Force Base in Solano County, California. I'm not familiar with that place, that region. Let's see if I can open it up in a new tab and zoom out. No, it won't let me zoom out. So I don't know exactly where that is. I think that's in Central California. But the bottom line is that this area here, several multimillionaires, including Flannery Associates, Michael Moritz, Reid Hoffman, the LinkedIn co-founder, and several others that are with venture capital like Horowitz. Doesn't really matter who they are. But the important thing is that they're buying up a whole bunch of property. You can see all these parcels that are all basically interconnected, basically buying up this whole, it's a huge land grab. So rather than rebuilding San Francisco, they're just saying, forget it, we'll find another place to build. And the wealthy are going in and snapping up all the land. Kind of like what the founder of Microsoft, I don't want to say his name because of YouTube rules, but you get the idea about all the land that he's acquiring. So let me drop out of here and just talk about real estate. So we know about mortgages going up. Mortgage rates are continuing to go up. They're almost at 8% now. That's way above the 3%. So you're almost at double what people were paying. Plus insurance and taxes are going up too. So basically it costs twice as much to afford a home. And the prices are still too high. They haven't quite come down yet to reset the market. And now you've got other pressures where, like, basically the real estate market really resets after Labor Day. And that's next week. So what happens is that after Labor Day, and if you all around the country, all around the U.S., people don't want to move because school starts. So if you have school-age children, they will get locked into a school. They want to stay there, and families want to hunker down for the winter, especially in the Northeast or the Northwest, as winter sets in and things get cold. Even in the upper Midwest and Chicago area, it gets cold there too. So as winter comes, as fall sets in, and then winter and then spring, that entire season of the school year, people don't really want to move. Most people only move during those months from September to March if there's a job relocation. That most people move or sell houses in March, sell and move in March to September. That's usually the season. So now we're about to get after Labor Day. Summer's essentially over at that point, and the real estate market just kind of piddles out. It just kind of it doesn't, not a rapid decline, but it kind of like smooths out, and just the real estate market really dries up. Now we have so many different messages out there about how few homes are available. People aren't moving. People don't want to sell because they are already in a 3% mortgage. So why would you get out of 3% and move into an 8%? It doesn't make a lot of sense unless you have to. Now, there's one more thing I wanted to share, but I almost forgot to do this. Let me share my screen one more time and talk about that inventory. This is a tweet that I grabbed. Feel free to follow me over to the Kobayashi letter. And here's what my tweet. You can see my Twitter handle. You can follow me there. That loud pop you keep hearing is the real estate bubble. So housing inventory is now at its lowest point in history. In the U.S., there are a total of just under 1 million single-family homes for sale. To put that in perspective, there were 3.5 million single-family homes for sale in 2008. That's almost 4 times as many houses that are for sale today. In 1987, there were about 3 times that number. However, back then, the U.S. population has, since 1987, the U.S. population has jumped by about 40%. This is the product of rapidly rising rates, with many people locked into 3% mortgages, as I said. Why sell if your house mortgage rate doubles? And here's the graph. It's a great graph. Single family housing inventory from 1985 to 2023. We're basically at historic lows. And it's just, there's not a lot of inventory. Again, people don't want to sell, they don't want to move unless they absolutely have to. So there's not many houses on the market because they know they're not going to sell. You're not going to get your price. And if people sell, they have to move somewhere. So where are they going to go when where are you going to move to when you're in a 3% mortgage and you got a nice house and you're all situated? Unless you have to move, you're not going to move. So that's basically the summary of the real estate market. All these different factors between Airbnb, no disposable income to buy income properties, rental prices are going up, so people can't even afford to go on vacation anyway. So why buy an Airbnb? All these different reasons are just basically going to suck all the value of the real estate market. And eventually there's going to have to be a reset, as the prices will have to come down, the mortgage rates will have to readjust. One of the two has to happen because people can't afford these payments on houses. So that's the real estate update for the market for right now, right before Labor Day. Again, please check out everything down in the description and on the crawl here. Looking forward to seeing everybody in Las Vegas. Get your tickets now. The tickets are dwindling out, but we're really excited about the event. We got lots planned at the end of September. Come out and see all of us at the Economic Preppers and all the other speakers there at the Silver and Sound Money Symposium. Looking forward to see you there. If you have any more comments, I'll read them all. Leave it down below. Again, like, share, and subscribe. Really appreciate it. But with all that said, I'm going to leave it there for now, and I will talk to you in the next video. Take care.